Hello, everyone. My name is Paul Stevens, editor of Short Term Rentals, and welcome to this Short Term Rentals webinar on exploring alternative sources of funding, sponsored by Price Labs and Hospitable. So I'm the editor of Short Term Rentals here at International Hospitality Media, and I'm also the host for today's session. And before we begin, let's just introduce our first webinar series sponsor, Price Labs.
Another industry milestone from Price Labs. Now with generative AI. Simplifying revenue management once again. Meet AI insights. Complex data transform into simple sentences. Market charts change into trend summaries. Experience AI insights today. Join the AI revolution at pricelabs.co.
Thank you to Price Lab.
I think one thing that Hospitable does that's really unique is we operate with extreme transparency. That means yes to our customers, but also internally to our team. And I think that really plays out and kind of sets the tone. Our customers feel really comfortable giving us feedback. We have these town halls that we do every other week where we give like a quick product update. Here's what we've done this week. And then we open up the floor and anybody who's on that town hall can say whatever they want. We don't pick and choose who's allowed to talk and we don't tell people to say certain things, you know, and our customers come to that and they give real feedback. I think one of the benefits of operating that way is like we don't have to only look to our competitors and say, oh, they just released this nice cool thing, it must be something we need to do. No, we are hosts ourselves, many of us, so we've experienced the pain ourselves and we know what needs to be done. And then our customers are hosts and they actually have a forum where they can share with us, feel comfortable doing so, and know that we'll listen and many times build things that solve those problems.
So big thank you to both of our series sponsors, Price Labs and Hospitable there. Got caught out a little bit by the video playing, but we're grateful, very grateful to have them both as series sponsors for our short-term rentals webinars. Hospitable is also providing a very generous offer of 25% off its platform for 3 months. All you need to do is go to the link on screen or in the chat now. So let's introduce our speaker lineup for today. So I'm going to ask you all to briefly introduce yourselves. We'll start from left to right and we'll go with Andrew first, please.
Hi, Paul, and hi, everybody tuning in today. Nice to be here. I'm Andrew Martin, the co-founder and CEO at Your Rentals. We are a short-term rentals management platform, providing an all-in-one solution for running your property management or hosting business.
Thank you very much, Andrew. And next up, Alex from Guest Ready.
Hi, I'm Alex, the co-founder and CEO of Guest Ready and Rental Ready. Guest Ready is a hospitality brand in the short-term rental industry where we help owners to make the most of their property by renting them short-term and create amazing guest experiences for guests that stay with us. And we provide an end-to-end property management solution. And then for scaling Guest Ready, we have created a property management system called Rental Ready that is now used by dozens of property managers, and we help them to scale their business. With Guest Ready, we're at over 3,500 properties, and hopefully we can help everybody that uses Rental Ready also to scale their business significantly.
Wow, thank you, Alex. And next up, we've got Yasha.
Hi there, everyone. I'm Yasha, a partner at Piper. We are a fund, private equity fund investing in consumer brands. So we're very specialist. We are obsessive about brand, but within the branded world, we do everything from online businesses to beauty to food and drink. But we do a lot in both hospitality, kind of physical site-based hospitality, bars and restaurants, as well as travel brands. So related to this, we're invested in the Thinking Traveller. It's a kind of luxury brand focused on villas in the Mediterranean, and a small group travel business called Rabbies as well.
Fantastic. Thank you, Yasha. Last but by no means least, we have Eduardo from Cedars.
Hey guys, good to be here. I'm Eduardo, been working at Cedars for the past 3 years. We sort of like help businesses raise funds from a network of retail investors and from their business communities. And yeah, we're one of the largest marketplaces in the world that connect founders, startups with investors. And yeah, glad to be here.
Thank you, Eduardo, and thank you to all of our speakers for participating today. Excited to hear this conversation. So we've got a couple of webinar guidelines just to run through very quickly. All of the details are going to be posted in the chat throughout by my colleagues, so please do go there if you have any questions you'd like to ask our panelists. We'll have a panel discussion lasting around 45 minutes, leading into some audience questions, and then a recording will be sent around to everyone within 48 hours of the session. And for a little bit of context as well, here are some of the major funding rounds we've seen in the short-term rental space so far this year. From Overmoon, emerging from stealth by raising $80 million in debt and equity financing in January, to Bob W, a property management company based here in Europe, securing 40 million euros in Series B funding in February. Blueground, another urban-based property manager, closing a $45 million Series D round in March. And of course, perhaps most notably, Guesty, a property management software, attracting $130 million in Series F funding. We don't see that too often, and now targeting an IPO. So very interesting to see what's ahead for Guesty. But otherwise, so some of those rounds you've seen are examples of maybe more conventional type funding rounds. But what if you're planning to go down a traditional series or venture capital round? We've seen Andrew's Your.Rentals raise 2.15 million euros last April with what was described as an innovative funding approach. Alex's own GuestReady went down its own crowdfunding route back in 2020, and Yasha from Piper can also provide a private equity perspective after the firm supported the Thinking Travelers' £7 million fundraise in December 2020. So a lot to get stuck into. Andrew, I'll start with you, partly because you're on the left and got it here. So as you said, you're co-founder of Your.Rentals, which is this all-in-one STR management platform since 2016. You yourself have gone through a number of raises. I'm not actually sure what the latest figure that you've raised in total to date is, but just looking generally at the funding landscape, how would you assess it right now? Some of the sort of challenges and trends that you're seeing.
Yeah, thanks, Paul. I mean, I guess during this webinar, it depends a bit who's listening in as to what sort of business you have and what sort of funding options might be viable for that business. So pick and take a little bit from what we're going to discuss. But I mean, in general, I think we at Your.Rentals have chosen to do our primary raises when the markets have been in the worst possible shape. I don't know why it's turned out like that, but we did our first bigger raise in 2020, right after COVID hit, and we did another one last year. So what is, I guess, the current status after COVID? The capital markets became very buoyant, so hitting some pretty strong levels in 2021, where we saw lots of investments going into lots of companies and almost a growth at any cost kind of mentality. But since then, of course, in 2022 and last year, we had high inflation, a lot of geopolitical instability with wars and regional conflicts, recessions and fears of recessions, which really led to a crash in capital markets. So the more traditional VC sort of funding really dried up. We saw valuations go down. So people who did raise money were raising money at lower valuations than maybe their previous raise. That can be big companies like Klarna and Spotify and others. And then the total amount of funding for software platforms, which is what we track, was well down 50 to 70%. So it's not the best time to be raising money, and that maybe forces us to be a bit more creative in our approach.
We will certainly talk about the more creative approach to funding shortly, but you also raised this venture capital round last year with seeders and with private placements as well. Actually, you did two rounds last year. I think I'm right in saying this. What was how did you find raising money back then, and maybe how have you seen the sort of sentiment shift since then too?
Yeah, it's a good question, Paul. So I mean, like we've kind of chosen not to go into a very traditional pigeonholed way of financing the growth of the company. And I think when you're also raising in difficult times when the capital markets are not that good, you kind of don't want to raise too much, because when valuations are low, then you end up, if you're using equity tools, then you end up diluting your ownership in the business. So our approach is trying to be a bit more, let's raise what we can, raise what we need for the next stage of growth with some pretty clear milestones. And you're right, last year we combined three prongs, I guess, private placements from people that had, signaled an interest in joining our business as investors. We also have, quite an active community of short-term rental hosts and property managers who rely on using our platform every day. So we wanted to try out the equity crowdfunding part, which we did with Seeders, and then we sort of topped that up with a VC ticket at the end. So probably that wasn't our plan at the beginning, but we knew what we wanted to raise, and I guess just through being adaptive, these elements all in the end supported each other.
I mean that's interesting. Sorry. Did you want to add something there? Did you?
It was only just to answer your next question. Was how does the outlook look? It's I don't think we're not fully recovered, but I think we've bottomed out in terms of the impact. You see interest rates have started to go down. You see there's GDP growth forecasts, and these sort of things tend to signal that there'll be a recovery in capital markets, and we start to see that now.
Thank you, Andrew. And I think the adaptability and in the funding landscape is possibly something we're going to hear about later on too. And of course, funding rounds don't always go exactly how they're planned to as well. But it's really interesting to get your perspective today. I'm going to turn to Alex next from Guest Ready. So Alex, you've got the property management aspect of your business, Guest Ready, which everyone I think in the short-term rental world would be very familiar with. And then you've also got the now PMS side of things. You've also recently won a Shorties Award for Best Sales and Marketing Campaign. So let me congratulate you on that. But how are you seeing from sort of two business aspects, I guess, the current investment landscape trends, and do they tally with what Andrew said?
Yeah, I think Andrew summarized it pretty well. We've been in business for 8 years now, 8+ years, and over these 8 years, the landscape has changed quite significantly. When we first started in 2016, we raised mostly from angels and very early stage investors, and then later in 2020 and 21, and actually also last year we raised additional funding with seeders, so with the crowdfunding. So we've seen different types of investors and had different conversations. Just to come back to the landscape, I think it depends also at what stage you are. We see that mostly actually later stage funding has been impacted. Series B plus, that kind of funding, I think came down by more than 70% or so, versus early stage funding has actually stayed relatively stable. So that's the good news. If you have an early stage business, angels or seed funding, that sort of funding has been pretty stable. But if you're at a much later stage. And also the examples that Andrew mentioned, Klarna, for example, those very late stage companies, many had to see the valuations come down quite significantly because it was much harder to raise funding. Yeah, I think that's what I wanted to say on the current environment, and on the state of the market. Yeah.
And I guess, are there, if we're talking about questions for the market, what would be the big questions really that still need to be answered in these uncertain times, do you think?
Yeah, I think also one thing that definitely changed is that people actually look at your bottom line, right? Andrew mentioned it in 2021. It was sort of this growth at all costs type of mentality where everybody's just looking at your top line, how fast you're growing, how fast you're capturing market share. But I think now people want to really see that you actually have a sustainable business that can turn a profit, that is ideally profitable already, or that can turn a profit with a very clear track towards that. So that is definitely something that changed. You also mentioned before, or you asked, like, how do you see it different between Guest Ready, which is more of a property management sort of hospitality business, and then Rental Ready, which is a software business. What I would like to say here is that choose the investors according to what kind of business you have. If you have a more traditional business, then you're probably ending up with angels, and then later on maybe private equity, and you're building a profitable business, and that's what we're doing with Guest Ready. And then with Rental Ready, that's the type of business, a software business that VCs are a great fit because they understand how to scale software businesses. They've done this many times, and it's very scalable, and there is a great fit. So I think I would just advise you to choose your investors carefully, right? It's not your investors choosing you, but you choose your investors. So do it according to what kind of business you're building. And especially the early investors, it's really important that they bring more than just money, that they can bring advice, that they have industry contacts, or that they have contacts to other investors, that they're aligned with your vision. Those things really matter, because once these investors are on your cap table, it's like a marriage, right? It's very hard to get rid of shareholders if you feel like you're not aligned anymore. So better be careful before letting somebody invest in your business. That's what I would say.
Thank you, Alex. Very valuable advice there. And there will be plenty more opportunity to get the advice of our panel today as well. Thank you, Alex. And next up, I'll turn over to Yasha as well. And Yasha, you've given a little snippet there of what you do with Piper, and the Villa Rental brand Thinking Traveller is one of the big ones in your portfolio. But I know you also have investments in other hospitality brands, not necessarily travel, but also in lots of different segments. So I guess, how would you sort of, with an overview of the current funding landscape, what is happening right now, and where does travel fit into that landscape?
I would say 2024 seems to be the year of travel. I think last year, speaking to lots of corporate finance advisors, everyone was saying there's a lot coming, and it has transpired. There's a huge amount of travel deals that have come to market in the UK, at least. And I think that's quite obvious kind of why that is. It's just been a complete dearth of funding for travel over the last few years in the kind of B2C market anyway. I'm less in favor of the B2B bit because that's not what I do. And as a result, you have kind of travel deals in kind of all the different layers. So you have like the big boys, that kind of either like actual trade, almost strategic trades that are coming to market, or you have kind of pseudo trade, which is kind of just like really big travel businesses turning hundreds of millions that I think will be sold on the basis that they'll be doing a lot of M&A, because that's what their growth will be predicated on, rather than just relying on organic growth through their core brand. And then you have obviously smaller travel brands, which are more the ones that we look at, which are also doing really well and are attracting a lot of interest, actually. I think brand Britain is very good for travel. I think British brands do really well in the US, which I can't say for many other sectors. You know, we invest across different consumer sectors: food, drink, beauty, fashion. And I would say it's a graveyard. The US is a graveyard of British brands that have attempted to cross the pond. But I would say in travel, it's just not the case. There's a kind of structural market reason for it, which is I think the US guys don't have as many brands and they still rely on agents a lot of the time. So actually when British travel brands go there, they seem to all do fantastically well. So as an investor, that's really attractive. The Americans got loads of money.
Yeah,
you can actually charge them more through dynamic pricing. You're smart with your tech.
I wonder from our conversation before we actually started this, whether there's going to be some news soon. So I'll definitely be hounding you after this.
There'll definitely be news. Less in short-term rental, but definitely in other parts of travel.
Interesting. Yeah. And M&A and profitability, these have both already been alluded to. But I'm wondering, Yasha, what are the big questions right now for investors? Is it when you're going to invest in a company, what are those questions that you're asking?
So once again, I'm coming at it from a kind of B2C perspective. And there's kind of B2B business on the panel, and I'm sure in the audience. I think it's going to be a different set of criteria. From a kind of B2C perspective, it's, I think for us in travel, it's really about finding that point of differentiation. There are a lot of travel brands that are good and do a good job, and they provide a good service to consumers, but they're not really that differentiated. And I think you can tell a lot about the level of differentiation of a travel brand by the margin.
Okay, thank you, thank you, Yasha. And last but not least, we've got Eduardo. So Eduardo, you're with Cedars, and you've given us a little bit of an insight there into what you do. But could you just explain really what Cedars actually is and how you go about supporting businesses when it comes to raising investment?
Of course, yes. So we're a complete private investment platform. I guess the main thing we're famous about is on equity crowdfunding, and what that means is that businesses can have the chance, so the opportunity to raise funds in a different way than going through institutional investors or, let's say, big ticket angels. They tap into their communities, into the business customers, into their social media followers and the people that resonate with the brand to raise investment, even if it's £100 tickets, 200, even 10 pounds you can invest in the business. So what we've seen is that global investment is down, and what has happened is that businesses are coming to us and equity crowdfunding to raise bridge rounds, or raise sort of like a more quick and efficient route to raising funds from their communities, from their customers, and they're offering sort of like democratizing access to their business, opening up for their most loyal ambassadors, and it's just an alternative way of raising funds. Again, it's adapting to the economic climate, and what the value that we bring to these businesses is that they can raise from their communities quickly, efficiently, but also we can push this investment proposition to our own investor network. And we have a network of 700,000 investors registered in a platform that are looking to build a portfolio of investment and also investing in businesses that resonate with, which includes hospitality, includes prop tech, but many other sectors as well.
That's it. You kind of answered my next question, but we'll be hearing more about Cedars again very shortly. Thank you, Eduardo. Andrea, I'll come back to you as well, because we've talked about some of the rounds that have been happening, and we've heard from Yasha, for example, that 2024 is going to be the year of travel. But what are the factors, do you think, why some businesses, maybe on the SaaS side, what are some of the reasons why they might have been struggling with the traditional routes of funding, and you've obviously gone down a different route?
It's a really good question. I mean, if we take a narrow look at B2B SaaS platforms or vendors in the short-term rentals space, then it's a pretty crowded landscape, you could say. I think it's quite hard to differentiate some businesses from others. So you need to have some type of edge to when there's a lot of competition for raising money. In more general, it goes back to a bit what Alex said. It depends what sort of business you have as to what sort of financing you can realistically target, what stage of growth you're at as well. Like Alex said as well. I mean, there has been a lot of pressure to show clear path to profitability, and that means people are adjusting a little bit their plan that may have been high growth before. But it's kind of funny, like a year ago, people, investors were saying, yes, we really need to see that clear path to profitability. 2 years before that, it was, let's focus on top line growth. And now it's kind of like, well, we'd really like to see both, which is, that's just the way it is. So we're always doing a balancing act. So you need to kind of know those sorts of things, and depending on the type of investor you're targeting, one of these may be more important than others. So you need to kind of listen out for those sort of signals, and of course you need to have a very interesting business as well to raise money when there's a lot of competition for the investments that are made. So one thing actually that we've been looking into, I mean, we've talked a lot about equity financing so far, but I think there's other options as well. One thing that we have been, let's say, looking into and probably using in certain ways is debt-based instruments, or sometimes they can be called revenue-based finance as well. So you've got vendors out there like CapChase, Float, FounderPath. There's actually many of them when you start to look for those that quite often specialize in a B2B SaaS business model or certain other types of recurring revenue models. And these didn't really exist, at least not in my vision 5 or so years ago. It was very hard to access, debt before you're profitable. But they've kind of structured these things and learned about these recurring revenue business models that they can actually provide different solutions. And the nice thing about those are that they're non-dilutive, right? So as a founder, you don't need to give up some of your equity for those. And as long as you do have a fairly predictable growth, they can be quite a good way or something new to add into your fundraising or financing your growth mix. So I would encourage people that haven't looked at those to have a look at them. I mean, they're not right for everybody. You also obviously need to be mindful that you don't take on too much debt, because you do have to repay it. That's the difference. But in some businesses at some stage, that might be another option you could look at.
Thank you, Andrew. Alex, is that something that you would concur with? And is it how is it maybe forcing businesses to look more for an alternative route towards financing?
Sure, I think it's definitely worth to look at different options, especially those that Andrew mentioned, non-dilutive options. I think if you have a business that can generate revenue from the beginning and can actually bootstrap to a certain extent and become profitable, you have then the option to also get debt, and traditional debt, that is bank loans, credit lines that are much more affordable than, let's say, if you go down the venture debt route, or if you do some revenue-based finance, it's much cheaper. But of course, you need to have a certain trading history, and you need to have profitability already unlocked, and that's not possible for all types of businesses, because for some businesses you just have to raise that first money to then invest, and then build a software, build a platform, or build up your brand before you then can get to a level where it makes sense to become profitable. But for some businesses, you can already start to bootstrap from the very beginning. So I think also just ask that question, like, why do you really need to raise equity funding? Do you really need to raise funding, or can you actually also make money just from your customers? I think there are other ways as well to work with working capital, maybe to negotiate payment terms with your suppliers and then have customers pay up front. And for example, Tesla pre-funded a lot of their vehicles, and of course you have to be careful if you take money from consumers. You need to make sure that you're not left in a situation where you owe them money and then you don't deliver. I think that's a very risky situation to be in. But definitely there are ways to finance yourself, also not with traditional funding, but with just running a super good business and actually bootstrapping from the beginning. I think that's the first question. Do you really need funding, or can you just bootstrap the business?
And we mentioned in the context pages that you've gone through crowdfunding as well. So could you talk a little bit about the experience that you got through that, and maybe what the whole process involved?
Yeah, sure. And also for crowdfunding, I think there are certain types of businesses that are more suitable for crowdfunding. I would say it has to be a business that is easily understandable by the average person, that people can relate to, that they can connect with. I think it's really helpful if you have a community that you can tap into, that are really engaged, or that are also somewhat financially savvy. So for us, actually, it was quite nice to have such a community, because we have many property investors that have properties with Guest Ready. And then also we have the whole guest community. I would say they're a bit less financially savvy on average than the property investors, than the hosts, but the community is very big. So we were able to tap into that community and engage it. Typically I would say it's more of a consumer play, but we've also seen other companies do really well, for example, on sustainability topics, or topics that people really care about, that they can relate to. As with any kind of fundraising process, actually, the key to a successful crowdfund for me is momentum and building up that momentum. And this momentum creates this fear of missing out, that people see, okay, this is a hot business. The things are really moving fast. If I don't join now, then I might lose out on this opportunity, and I just won't have the opportunity to join this exciting journey of this company. So yeah, that's super important. And it can also go the other way around, of course, that people see, oh, things are a bit slow, like there are not that many investors, and I'm not sure if I should really join, because it doesn't seem like it's a great business that lots of people want to invest in. And the way to build this momentum is to go through a few different stages, and Seedrs has been super helpful to help us with creating this momentum and creating the different stages of the fundraising process. We raised our first round in 2020, and back then actually we didn't know anything about crowdfunding. We just thought it would be great to engage our community. We were in the middle of COVID pandemic. Nobody really knew if there would be vaccines and so on. So it was impossible to raise funding from institutional investors. But we thought that our community and people that can relate to travel, they would believe in this investment opportunity, because they see or they believe that there would be a way around COVID. And obviously it came that way, but back then professional investors, institutional investors didn't want to take that risk that private investors were willing to take. And the way how we did it is actually, first there is a pre-registration phase. In that pre-registration phase, you just tease that there is this opportunity. You give very little information, but make it look very interesting, of course, and then people sign up with their names, and you collect a lot of interest. and then you go live in a private campaign where the target is to get a certain size of a certain number of investors already, so that once you go live publicly, you can show, okay, like it's not just one person that invested, but it's a hundred or a few hundreds that already invested, and that gives everybody else that then sees the campaign the confidence that they're not alone. They're not the only fool that believes in this business, but they're like, that gives you this validation that lots of other people looked at it. And also one thing that I think, there was a question on this actually in the Q&A, but ideally you need to have a significant amount of the funding that you want to achieve already pre-committed from ideally existing investors, or maybe some new investors that come in that already have like, let's say at least like 50, 60, 70 or even more of what you hope to achieve already committed, because then again that gives everybody the confidence that this is a successful funding, that the business won't be running out of money anytime soon, gives the stability and so on. So these are some things that I think are important, that worked out well in our favor when we did the fundraisings.
Thank you. And Yasha, Alex raises some really interesting points there. So I'd like to get your perspective on why you think it's important to go down the right funding route for your business, and also at the right time. Do you have any sort of thoughts on this from a private equity angle?
Yeah, I think different types of investors have different expectations, and they come with certain pressures, right? So it's at our stage where we invest in, I guess, businesses turning over, say, kind of 6-7 million plus, and they're not startups anymore. They're kind of growth phase, still entrepreneurial, but I think it's a different kind of growth momentum. We have this way of thinking about Pipe, which is 7, 17, 70, which is 7 million, 17 million, or 70 million. It actually works really well in hospitality in terms of number of sites, or it could be number of people. What we've observed over the last 40 years is there are some natural growth inflection points that businesses go through, and businesses need to adapt ahead of those inflection points. Because if they don't, then they will, either the customer experience will start getting worse, or your growth starts slowing down. And it's really ahead of each inflection point, really thinking about, are these the right people for the next stage of growth that I've got in my team? Have they got the right skills? Are my operations and my tech right? Is my brand building strategy right? All those things. I mean, our role as investors is that kind of, at Piper anyway, is that 7 to 70. That's our expertise. And it's really kind of being kind of cognizant of those inflection points and getting them ready for it. But the brands need to be aware of what they're going to have to do to grow through those inflection points. And some businesses are just not ready for that. And we're very open with that and say, you're not ready. You need to maybe go and do a smaller round, maybe with some angels. You need to work on these areas, and then you might be ready for a private equity round. I think VCs are probably a little bit more open-minded in terms of the businesses being very raw. I'd say the private equity. And angels are going to be very open-minded about the level of rawness, if that's right. So I think you've got to understand if you're ready for the expectations.
And thank you, Yasha. I guess Eduardo, I'll come to you on this next point. I've seen there's quite a few questions coming in for you on the Q&A, so we'll try and get through as many of those as we can later. But could you expand, Eduardo, a little bit on the sectors that you work with at Cedars, and are there any sectors in particular that are performing really well right now, even if it's not travel?
Yeah, so we work with around 300 businesses per year, so it's businesses from all sectors across all stages. We're pretty much sector and stage agnostic, even if it's pre-seed, seed stage, up to pre-IPO. And I think we can add different types of value for the different businesses at the different stages from the different sectors. So it's it's not fixed. It's very much on a case by case basis. But what I've seen in terms of interesting sectors where tech typical tech businesses within prop tech, fintech, insurtech tends to work really well. But the one that we have been pretty much impressed over the last couple of years is sustainability and climate tech, and particularly climate tech. We have seen a huge appetite from our investors in businesses that are complex technologies, hardware, B2B, big infrastructure businesses, where we have started to we have raised millions of pounds of investment just from Seedrs investors. So and the reason is I think that the Seedrs investor base is becoming a little bit more sophisticated. We're becoming a much more investor-led platform as well, so that investors can actually manage their portfolio of investment better than before. So climate tech is becoming big, and others divisions in deep tech like AI, any business, tech business with a huge focus on AI has also become big. So it's definitely interesting that our investors are looking into B2B more than ever, even if it's hardware technology, which is very interesting and cool to see. Yeah, also things like robotics or machine learning and robotics, things like that are pretty interesting narratives is becoming big. So we're working with many different cool businesses.
And given how many questions we're getting for you in the chat, could you give us a bit of an overview of what a typical Seedrs raise looks like? What kind of is the process of it, and how does to sort of answer as well, one question is, how does Seedrs select the companies to partner with?
Sure. So it's there's different ways on how we get in contact with businesses. I mean, we receive tens of thousands of applications per year from our website, but we also get referrals from founders like Andrew and Alex. We get connections within conferences, events, word of mouth. So there's different ways of how we get in touch with potential businesses, and then we have a thorough analysis on whether it's suitable for the platform or not. And then we have several calls, perhaps, meeting the founders, understanding more about the business, and then ultimately we have an investment committee which we present businesses that we will speak to every week, and then we sort of like select the businesses that we think would do well in the platform based on their traction, their revenues, their community size, their sector that they play in, the quality of the founders, which I think is one of the most important things. And then, well, the process in general from start to finish is about 2 to 3 months. Let's say 3 months, because no process is the same. Each business is a different world, so it all presents some challenges and bumps. It's not an easy process, but we try to make it as smooth as possible and as efficient as possible. But what founders like about us is that there's a start line, there's a deadline, and we don't get the rounds open forever. So we put pressure into our investors, into the communities to invest, make decision quickly to invest. And I think founders see value on how quick can this process be compared to getting investment from VCs or others or angels, perhaps. So the process again is about 2 to 3 months. 1 month to prepare everything, prepare the campaign, do the diligence in the business, and then 30 days normally on the platform to execute the campaign and start collecting investments.
Thank you, Eduardo. That's really fascinating. And those sort of insights you don't often actually hear on a stage like this. So it's really good to get those. And I'll turn to Yasha, our other investor as well, because I think for the benefit, Yasha, of our audience here, what would be, we've heard a little bit about some of the shifting priorities for investors over recent years and the interest that travel's getting this year. What would be your advice to founders or CEOs who are deciding on their funding routes right now?
I think there's a lot, there can be a lot of noise at the moment. I think the businesses that are attracting particular attention are the ones that have managed to build up quite a profitable business model. I think that's that, and that, I think it was mentioned earlier that profit has become this a buzzword. I think there's always been a buzzword for us at Piper, but it hasn't necessarily been that for the last 10, 15 years. I think it's a good thing that it is. I think hopefully it'll lead to more sustainable business models, better businesses, slightly calmer CEOs and founders, less stress. But I think it's trying to think about what is your aspiration and your growth momentum. I think finding the funding solution that reflects that. You might be a VC business, you might not be, and you have to kind of look yourself in the mirror and go, am I the kind of founder, or am I the kind of business model that can handle really fast growth? Do I want it? Private equity, if you're a bigger business, actually doesn't require huge growth. I think you can double businesses over 5 years because of the profitability. So I think it always comes back to quite personal. It's kind of personal thing of like, how do you want to grow the business, and ultimately what is your business model and what kind of growth can it handle, and who you're going to sell it to.
Thank you, Yasha. Thank you everyone for the questions coming in. I'll certainly make a little bit of time at the end to ask our panelists those. I just want to get the thoughts of our two short-term rental companies, two companies that have raised funding in recent years, and get their advice really. So Andrew, you've been patient there. So as someone who's gone through several rounds, even in the last year, what would be your advice to your counterparts, and maybe what they need to prioritize when looking at funding opportunities?
Yeah, I think start from the point that Yasha just mentioned. I mean, be clear about what you want to do, what your goals are, and that will often dictate what sort of finance options are right for you. Back to what Alex said before, also choose carefully. I've been an entrepreneur for 20 years, and one of the most valuable lessons I've ever learned was choosing angel investors at the very beginning. So I think it's really important that you align at the value level, not just see this as a check that they're writing, because and you should think about how will it be to be with these people when things are not going well. That's equally as important as when things are going well, because we've all lived through the COVID years, right? And that was possibly the most challenging era for travel related businesses. So if you've got good investors that will stick by you and give you good advice and are patient, then it helps in the downtimes as well. And then I think the last thing that we're focused on at the moment comes back to one of the other topics we discussed, is that balance between growth and profitability. So right now we have been very focused on a pathway to profitability, which we're well on track, but also then maintaining the growth and in a very capital efficient way. That's what investors are looking for, I think, across the gamut at the stage we're at. So that's the balancing act we're trying to take right now.
Thank you, Andrew. Alex, I mean, same question really to you as a business that raised. I don't want to dwell too much on.
I think don't worry. I think there's also not too much to add. There's not too much to add after what Andrew and Yasha said. I think they summarized it really well. To maybe make it a bit more specific to short-term rentals, I would say if you're a very operational business, a property manager or an operator, then I think you have a great opportunity actually to build a revenue generating and profitable business from the beginning. Of course, in the beginning, it's always hard. Maybe you need a bit of money to kickstart things, but I don't think this kind of business needs a huge amount of equity or of fundraising. But on the other side, if you're investing in technology, then probably you're going down more the investor route, probably later the VC route. And as we also heard from Eduardo, if you're doing anything with AI, then this might be something that people are very excited about. But then also coming back to what Andrew said on capital efficiency, also with AI, it allows everybody in the team to be much more efficient, and probably even for technology businesses, you don't need to raise as much as maybe you needed to raise a couple of years ago, because it's much easier to build a prototype, to build your MVP, to test, and everybody becomes more efficient. So I would say, yeah, try to really think it through how much you need and what is the right level of funding as well, and who would be the right investors. And yeah, just be very mindful with setting up your strategy before you go ahead.
Thank you, Alex. Let's get through a couple of audience questions, because there have been quite a few coming in. I'm not sure who's perhaps best to answer this first question, but I'll ask it anyway. And it's interested to hear your perspective on strategic investors, e.g. hotels or even fashion brands. Yasha, potentially, would you like to sort of come in on that, given your sort of spread of expertise over several sectors?
What's the actual question?
So I guess it's you getting your perspective on strategic investors, and that could be across several different brands. I'm not 100% sure if the person who asked that question could expand a bit more. Otherwise, I can move on to the next question.
Well, I would have some thoughts, I guess.
Yes.
Like we raised from some real estate investors, so that there's some strategic angle for some of them. Also, we manage some properties, and I think that's really nice if there can be this symbiosis of somebody that is somewhat also even a customer. So I think that's great. On the other side, if you raise from strategic investors that could be seen as your ideal acquirers later on, you might want to be careful how much you let them decide your roadmap. So for our strategic investors, they don't have a board seat, they don't have that much insider information. They get the same information than other shareholders. But if you give them too much control rights or information rights, then this might be difficult then later to create a successful exit for you, because every other buyer might say, okay, either I overpay, I get the deal, or I don't overpay, and then probably they will buy the company anyway. So I think that's just something to be mindful of when thinking about strategic investors, to be quite careful in these considerations.
Alex,
it's quite,
yeah, please do.
It's quite tricky with strategic investors. I think where we always end up competing with them sometimes, because actually at one point they were quite big fans of doing earn-out deals. So they act almost like private equity sometimes, where they'll kind of buy out maybe previous investors, and then over like 5 years they'll do an earn-out with you, which actually for a founder I think can be kind of very, very attractive. I guess as long as the terms are that the earn-out hits. The worst case scenario, and this has happened in, I don't know, like Diageo had this kind of Distill Ventures, which was for young brands, spirits brands, where the articles meant that they were kind of stuck at the end, and then really selling the business was very hard, because to an investor they're saying, well, the strategics don't want you, clearly, because they've just been in your ecosystem and now they don't want to, so why would I want them? Who are you going to sell it to? So it's one of those where like it can be very attractive, but be really careful about if it doesn't work out, and it's very high chance it doesn't work out for a reason. What is your downside protection?
Thank you, Yasha. I think we've covered a few points there, and we've covered a few of the questions as well about Cedars already about which stage of growth Cedars works with companies usually. There is a recording going out anyway after, so if there's anything that you've missed, then you can go back and see that. But Eduardo, I will ask you this because I don't think we've necessarily covered it. So the question is, Eduardo, if you have raised funds already from some angels, does Cedars still require a further angel or VC fund to raise funds alongside the Cedars raise? And what are the typical tickets that Cedars focus on? Are you able to give your 2 pence on that?
Yep. I mean, we want to participate in fresh rounds, in rounds that have been raised, or like, for a little bit of context, we act as a follow-on investor, right? So we sort of like plug in on rounds that are currently being raised or have been raised in the past, but it has to be sort of like recent rounds. It cannot be a round that was raised by angels a year ago and then we can top that up. We have sort of like that timeline of no more than 6 months from the moment the capital got into the bank account till we go live. So it should be a fresh round of fresh capital where we can plug in on the back of that and act as an add-on of the round. And when it comes to the ticket sizes, I believe the question is on what's the average ticket size that we see on the platform. And again, the nature of our investors is retail investors, is small tickets. So we're looking around £700 per ticket per investor as an average across the different sectors. And the idea is to get thousands and thousands of these investors.
Thank you, Eduardo. I think thank you very much, Sasha, too, for your questions. Probably got about 30 seconds left. So Yasha, very, very quickly, based on a question from an anonymous attendee, and we might have already covered it, but at what stage of growth does Piper work with companies usually?
So it's when they're turning over, say, roughly 5 to 30 million turnover, and looking to raise a minimum of 5 million. That's kind of our smallest check that we would write, but we prefer to do actually bigger checks than that.
Excellent. Thank you for answering that question, Yasha. Hopefully that satisfies the person asking the question. I should say all of the contact details of our speakers have been put in the chat as well. So if you want to reach out to them at any point after this session, then please do. But remarkably, our hour is up. So I want to say a big thank you to all of our contributors today, to Andrew, to Alex, to Yasha and Eduardo. I think we could have spoken for a lot longer, but it's been a fantastic discussion today. So just got a couple of quick slides to go through with everyone briefly. So we're back next Tuesday, the 28th of May, for a webinar in partnership with Welcome Pickups on Next Gen Hospitality, Embracing Automation for Superior Guest Experiences. We sort of talked a little bit about AI and automation already, so hopefully it's something that you'll find interesting there too. Alex's colleague Francois from Guest Ready is also participating, and the sign-up link is in the chat for you now. For opportunities to work with us, please do contact my colleague Jordan, whose details are on screen now. And it's a great time to be working with us too, whether it's on events or on our podcast, and of course our webinar content as well. So we'd love to hear from you. We're going to keep the session open for another 2 minutes. If you want to jot down any of the details from chat from any of our speakers today, I want to say a big thank you to Price Labs and Hospitable for their support and their sponsorship throughout this series. Big thank you to our excellent speakers again, and of course to all of you for tuning in today, and we'll see you again very soon. Thank you very much, everyone.
Thanks, Paul. Bye.
Hello, we are International Hospitality Media, or IHM for short. IHM is the #1 brand to engage with decision makers in hospitality and real estate. Our 4 multimedia brands lead their respective sectors with breaking news, comments, trends, and opinion across a variety of multimedia solutions. We provide an inspirational community to connect people through world-class events, webinars, podcasts, award schemes, and much more. But let us share our story of who we are and what we do. Over 10 years ago, Piers & George had a light bulb moment to provide expert opinion, comments, and low-cost digital content. And so they went on a journey over the past decade, creating media platforms to serve the hospitality and real estate industries. We now have an engaged audience with a reach of over 60,000 monthly visitors across our website, 48,000 of our email database across all the sectors, and over 67,000 across our social channels. Everything we do believe in challenging the status quo. We believe in thinking differently. We make things simple and very easy to work with us. And we're a friendly bunch too. We offer creative solutions to help you achieve your business goals. Read, watch, listen, meet with IHM. Contact us for a chat today. Just look at some of the brands we have worked with recently.